Let me start with a number that should be on every front page in America, but somehow isn't. $7 trillion. Not $7 trillion in debt. Not $7 trillion in spending. Not some theoretical number in a congressional budget spreadsheet. $7 trillion in liquidity, the bloodstream of the financial system, quietly disappeared from U.S. markets in a short span of time. And most people didn't notice because the stock market kept moving. Headlines kept screaming about inflation and elections, and social media kept distracting everyone with the next outrage. But the financial system isn't powered by headlines, it's powered by liquidity. And when liquidity drains, everything else becomes fragile, even if it looks fine on the surface. This isn't a conspiracy theory. This isn't the banks are hiding something. This is a measurable, trackable shift in the plumbing of money. It shows up in the Federal Reserve's own data. It shows up in Treasury auctions. It shows up in overnight lending markets. It shows up in the quiet behavior of institutions that never tweet, never do interviews, and never explain their moves to the public. By the end of this video, you'll understand what that $7 trillion really represents, where it went, why it matters more than almost any headline number, and why history shows that when this kind of drain accelerates, the system doesn't gradually adjust, it snaps. Hit subscribe and tap like. It's the best way to support the channel and helps this message reach more people. When people hear $7 trillion vanished, they imagine money being stolen or cash being pulled out of vaults and loaded into trucks. That's not how this works. What vanished wasn't paper currency. What vanished was available money in motion. The kind of money that makes credit cheap, keeps asset prices inflated, and lets governments finance massive deficits without immediate consequences. In simple terms, this $7 trillion is the reversal of the biggest financial sugar high in U.S. history. The post-2008 era and the pandemic era, when the Federal Reserve and the banking system flooded markets with money. After 2008, the Fed created new money to buy assets, mainly treasuries and mortgage-backed securities, to stabilize the system. That grew into a permanent policy tool. Then 2020 happened, and the money fire hose went fully industrial. The result was a historic surge in liquidity. It lifted everything: stocks, real estate, crypto, private equity, tech valuations, even collectibles. But then something changed. Inflation forced the Fed to reverse course. And when the Fed reverses course, it doesn't just raise rates. It pulls the oxygen out of the room. The $7 trillion didn't vanish in one dramatic day. It disappeared through several invisible drains, each one boring on its own but deadly in combination. The public watches the stock market. Institutions watch something else: the pipes. There are three major liquidity drains that most people don't understand because they aren't discussed in everyday finance content. The first drain is the Federal Reserve shrinking its balance sheet. When the Fed was buying assets, it was injecting fresh money into the system. When it stopped buying and began letting assets mature without replacement, it was doing the opposite. This is called quantitative tightening, but that name sounds cleaner than reality. Reality is, it's money leaving the system. The second drain is the Treasury itself. When the government runs massive deficits and issues enormous volumes of new debt, it competes for the same money markets rely on. In an environment where rates are higher, the Treasury becomes a black hole. The more it borrows, the more liquidity it absorbs, especially if the buyers are short-term institutions shifting cash into government bills for safety and yield. The third drain is the reverse repo system. This is one of the most misunderstood parts of modern finance. At certain times, enormous pools of institutional cash park money at the Fed overnight. When reverse repo balances were high, it meant money was sitting idle. As those balances fell, it looked like liquidity was returning, but the truth is more complicated. It was shifting locations inside the system, often in ways that expose stress elsewhere. These drains interact like gears. When they turn together, liquidity disappears far faster than people expect. And that's how you can lose trillions without a single dramatic headline. Here's why the story stays under the radar. Liquidity doesn't vanish in a way that feels immediate to ordinary people. You don't wake up and see a liquidity shortage sign outside your local grocery store. At first, it shows up in places that only insiders watch. Funding markets, bond volatility, credit spreads, the behavior of dealer banks, the appetite at Treasury auctions. Then it spreads into asset prices, but in a deceptive way. The first phase often looks like a rotation. Tech falls, energy rises, growth falls, value rises. One sector drops while another holds. That keeps people calm. But the reality is that during a systemic liquidity drain, these rotations are just the early tremors. The real quake comes later when liquidity becomes scarce across the entire market at once and correlations go to 1. That's the moment everything sells off together, even safe assets. And that's why liquidity drains are the most dangerous financial events. You don't feel them until they become unavoidable. Now we get to the most important part of this story. When liquidity drains, capital doesn't just disappear, it moves. And where it moves tells you what the smartest, most powerful players believe about the future. Over the last few years, we've seen a slow, quiet shift away from risk-heavy, dollar-sensitive assets into three broad categories: short-term government paper, real assets, and international diversification. Here's what that looks like in real life. Institutions that used to chase long-term growth started stacking short-term treasuries, not because they love the U.S. economy, but because they want yield without duration risk. That is a defensive move. It's not bullish. Wealth that used to sit in broad market ETFs started moving toward energy, commodities, industrial supply chains, and infrastructure, assets tied to real-world scarcity. And high-end capital, family offices, multinational executives, and institutional allocators quietly expanded exposure outside the U.S. into more politically stable, fiscally conservative jurisdictions. This isn't anti-America. It's rational behavior when the world's core financial system is under stress. The public stays focused on narratives. Institutions focus on survival. Let me tell you something that will change how you see the entire financial world. Modern finance isn't powered by cash. It's powered by collateral. The U.S. Treasury market isn't just government borrowing. It's the foundation of global collateral. Treasuries are used to secure loans, settle trades, and support leverage. So when liquidity drains, it often shows up as a collateral problem first. This is why bond market instability is far more dangerous than stock market volatility. Stock market drops are loud. Bond market breakdowns are lethal. When bond volatility spikes, collateral becomes less reliable. When collateral becomes less reliable, leverage shrinks. When leverage shrinks, forced selling begins. And forced selling doesn't care about fundamentals. It only cares about margins. This is why smart money watches bond market plumbing like a hawk. Because the financial world is built on a fragile pyramid of collateral confidence. When the drain accelerates, the collateral pyramid starts wobbling. The most important idea in your original script is this: the pattern repeats. Liquidity drains are not new. Empires have always experienced versions of this, even before central banks existed. The names change, but the structure is the same. Stage 1. A nation becomes the center of global finance. Capital floods in, confidence grows. Its assets become the default safe haven. Stage 2. Overextension. Debt grows. The state becomes too expensive to maintain. Costs rise faster than real economic output. Stage 3. Silent exodus. The smart money starts shifting quietly. Funding becomes tighter. The center still looks strong, until it doesn't. Stage 4. Snap. Spain's imperial system didn't collapse because people hated Spain. It collapsed because debt service, war costs, and monetary debasement destroyed confidence and capital relocated north. The Dutch financial system didn't collapse because everyone stopped trading. It collapsed because the banking model was overstretched and war pressure exposed the weakness. Britain didn't lose the pound's dominance because the world wanted America more. It lost it because it could no longer afford the global role it once held. Every time, the transition looked slow until it looked sudden. And every time, the first sign wasn't political chaos. It was capital moving quietly. This is where the average person gets trapped. They hear about $38 trillion in national debt and think that's the main danger. Debt is dangerous, yes. But liquidity is the switch that turns debt from a burden into a crisis. As long as liquidity is abundant, the government can finance deficits cheaply. Banks can roll credit. Asset prices can float above reality. Everyone feels fine. But when liquidity drains and interest rates remain high, the government's debt becomes heavier every month. Refinancing becomes more expensive. Treasury issuance becomes more frequent. Buyers demand higher yields. That pushes rates up again. That accelerates the drain. It becomes a feedback loop. This is why a liquidity drain can turn a manageable debt problem into a crisis faster than anyone expects. Debt is the pile of dry wood. Liquidity is the match. This is the part nobody wants to say out loud. When the drain accelerates, it doesn't just lower stock prices, it restructures society. The first visible effect is that borrowing becomes expensive for everyone. Mortgages climb, car loans climb, credit card rates become predatory. Small businesses lose cheap credit. Consumers stop spending. Then corporate refinancing becomes painful. Zombie companies, firms that survive only because credit is cheap, start dying. That raises unemployment. Then tax revenue falls. But government expenses do not fall. They rise because social spending increases during downturns. So deficits widen. So borrowing increases. So liquidity tightens further. This is how the financial system goes from tightening to stress to breakage. And when breakage occurs, it usually happens in one of two places first: a major bank or a major market. Sometimes it looks like a credit event. Sometimes it looks like a hedge fund blowing up. Sometimes it looks like a surprise failure of an untouchable institution. But the root cause is always the same. Liquidity dries up, and the system that depended on leverage realizes leverage is no longer cheap. Then the forced selling begins. Here's one of the strangest things in global finance, something most people never learn. Even though America prints dollars, the world can still experience a dollar shortage. Because outside the US, banks and companies borrow in dollars to trade commodities, service debt, and settle transactions. When global liquidity tightens, those dollar borrowers scramble to secure dollars. This demand makes the dollar rise. That sounds like strength. But it's the kind of strength that happens during stress, like a person's pulse rising during a panic attack. A rising dollar during tightening is not always bullish. Sometimes it's a warning sign that global funding markets are choking. And when dollar shortages become severe, global trade slows, emerging markets crack, and financial contagion spreads back toward the core. This paradox is why the dollar is strong can coexist with the system is breaking. You might be thinking, okay, but if this is a high-level institutional liquidity story, why should the average person care? Because liquidity drains always hit the same group hardest, people whose wealth is trapped inside the system. That means workers paid in dollars, savers holding cash, retirees holding fixed income portfolios, middle-class families holding home equity and retirement accounts. The wealthy don't survive because they're smarter. They survive because they have flexibility. They hold multiple assets, multiple jurisdictions, multiple options. They can move. The middle class can't move fast. Their wealth is concentrated. Their cash flow depends on stability. Their job depends on credit-driven economic momentum. That's why the personal stakes are real. Liquidity drains are not just market events, they are social events. They quietly reshape who gets to own assets and who gets priced out. Now, to be clear, this does not guarantee an overnight collapse. History rarely works like a movie. What usually happens is worse, a slow transition that feels manageable until it becomes irreversible. You don't need a single crash day for a system to break. Sometimes the break is structural. Living standards stagnate. Housing becomes unreachable. Debt becomes normal. Inflation becomes permanent. Savings stop working. Wealth inequality hardens like concrete. And through it all, the financial system continues, but with a different outcome than before. A tighter, harsher system. A system where the cost of capital remains high. A system where only the strongest balance sheets survive. A system where the American dream becomes a luxury product. That is what liquidity drains can create. Not just a market correction, a reordering. If you remember one thing from this article, let it be this. The most important shifts in finance do not announce themselves. The smart money does not ring bells. It does not post tweets. It does not hold press conferences. It moves quietly, systematically, and early. And the way you detect it isn't by watching headlines. It's by watching the boring numbers. Liquidity, funding markets, treasury demand, interest costs, the hidden drains in the plumbing. That $7 trillion didn't vanish randomly. It was pulled because the system is tightening. And when the drain accelerates, it won't feel like a story. It will feel like life getting harder, faster, and more expensive with fewer options. This is why this matters. Because by the time the public recognizes what happened, the repositioning phase is already over. The only question is whether you'll understand the system while it's still quiet, or whether you'll be forced to understand it after it becomes loud.